What if the biggest mistake silver investors are making right now isn't buying, selling, or holding? What if the real mistake is misunderstanding what actually caused this collapse in the first place? Because over the last several days, fear has spread across the precious metals market at an incredible pace. Silver has fallen to roughly $73 an ounce. In just 1 week, it lost around 14% of its value. From the highs reached earlier this year, the decline now exceeds 50%. To many investors, those numbers sound like evidence that something has gone seriously wrong. Social media is filled with predictions of further losses. Headlines are describing a market in freefall. Long-term holders are questioning their convictions. New investors are wondering whether they should stay away completely. Yet beneath all the noise sits a reality that very few people are discussing properly. And until you understand that reality, it is almost impossible to make sense of what comes next. The reason this matters is simple. Markets often punish investors who focus only on outcomes. A falling price grabs attention immediately. It creates emotion. It creates fear. It creates urgency. But a price move by itself does not explain why something happened. And without understanding the cause, every decision becomes a guess. That's exactly where many silver investors find themselves today. Some are selling because they assume the long-term story is over. Others are holding but have no confidence in their position. Some are waiting for a signal but don't know what signal actually matters. Everyone is looking at the same chart, but very few are asking the question that matters most. Why did silver really fall? That single question changes everything. If the answer is that silver's underlying investment case has broken down, then today's decline could be the beginning of a much larger problem. If industrial demand is collapsing, if supply shortages were exaggerated, if the market fundamentally mispriced silver's future, then lower prices would make sense. In that world, investors would need to rethink everything. But what if that's not what happened? What if the price collapsed while the underlying story remained largely unchanged? What if the trigger came from outside the silver market entirely? Because when we examine the evidence carefully, that's exactly what appears to have happened. The truth is that silver's decline has far more to do with monetary policy than with silver itself. To understand why, we need to look at what changed in the broader financial system over the last week. Only a short time ago, investors were becoming increasingly confident that the Federal Reserve was nearing the end of its tightening cycle. Inflation appeared to be moderating. Oil prices were moving lower. Markets were beginning to believe that policymakers would soon have room to take a less aggressive approach. As confidence in that scenario grew, expectations for future rate hikes declined significantly. At one point, the market assigned only about a 57% probability that another rate increase would arrive before the end of the year. Then sentiment shifted. Suddenly, investors began reassessing the inflation outlook. Major financial institutions adjusted their forecasts. Concerns emerged that inflation could remain more persistent than previously expected. The Federal Reserve's preferred inflation measure was projected to move toward 4.1%, compared with an earlier reading around 3.8%. At the same time, policymakers continued emphasizing their commitment to bringing inflation under control. As those expectations changed, markets responded quickly. The probability of another rate hike surged toward 90%, and that is where the silver story really begins. Because silver does not exist in isolation, every major asset class is connected to the broader financial system. When expectations for interest rates change, capital flows across markets. Investors begin repositioning. Entire sectors can move sharply even when nothing about their underlying fundamentals changes. Silver is particularly sensitive to this process because it is a non-yielding asset. Unlike bonds, silver does not pay interest. Unlike savings accounts, it does not generate cash flow. Its value comes from scarcity, utility, and investor demand. That means when interest rates rise, silver often faces immediate pressure. The logic is straightforward. If cash begins earning a higher return, some investors become less interested in holding assets that generate no income. Money shifts toward instruments offering yield. Demand for those instruments increases. Demand for precious metals can weaken. But that's only half the story. The second effect is arguably even more important. Higher interest rate expectations tend to strengthen the US dollar. As investors around the world seek better returns, capital flows into dollar-denominated assets. That increased demand pushes the currency higher. And because silver is priced globally in dollars, a stronger dollar creates additional pressure on silver prices. For buyers outside the United States, silver effectively becomes more expensive. That can reduce demand, that can slow purchasing activity, that can push prices lower. So when markets suddenly shifted from expecting a relatively calm Federal Reserve to pricing a much more aggressive one, silver was hit from two directions at the same time. Investors moved toward yield. The dollar strengthened dramatically. Both developments worked against precious metals, and the impact wasn't limited to silver. Gold also came under pressure during the same period, dropping below 4,000. That detail matters because it tells us something important. When multiple precious metals decline simultaneously following a major shift in Federal Reserve expectations, it suggests the driver is macroeconomic rather than metal-specific. In other words, the pressure came from outside the silver market. Now let's take this one step further because this is where many analyses stop. The dollar recently climbed above the 100 level on the dollar index, reaching its strongest position in more than a year. On the surface, that sounds like a simple currency story. But underneath, it reveals something much more important. Markets have become heavily positioned around the idea that the Federal Reserve will remain aggressive. Think about what that means. A large portion of investors are already assuming another hike is coming. A large portion of investors are already expecting tighter policy. A large portion of investors are already positioned for continued dollar strength. And whenever expectations become concentrated in one direction, markets become vulnerable to surprises. This is one of the most important concepts in investing. Prices don't move based solely on what happens. They move based on the difference between what happens and what people expected to happen. Right now, expectations have become extremely one-sided. The dollar is benefiting from those expectations. Silver is suffering because of them. But if inflation begins cooling faster than anticipated, if economic data weakens, or if any development causes markets to rethink the need for additional tightening, that entire equation can change surprisingly fast. The same mechanism that pushed silver lower could eventually help push it higher. And that possibility is exactly why understanding the cause of this decline matters so much. Because once you realize the sell-off was driven primarily by Federal Reserve expectations and dollar strength, a new question immediately emerges. What actually changed inside the silver market itself? The answer to that question may be the most important part of this entire story. Because while prices collapsed, many of the factors that originally attracted investors to silver appear to be exactly where they were before the decline began. Part 2. That brings us to the critical distinction almost every panic-driven market eventually reveals. Price and fundamentals are not always the same thing. In fact, some of the most dramatic moves in financial history occurred when the market price temporarily disconnected from the underlying reality. Investors often assume that a large decline automatically means something fundamental has deteriorated. Sometimes that is true, but sometimes the price moves first while the underlying structure barely changes at all. The silver market appears to be sitting directly in the middle of that debate today. Let's start with supply. For 6 consecutive years, global silver consumption has exceeded the amount of silver being mined and recycled. That trend did not suddenly reverse because investors changed their expectations for interest rates. The imbalance remains in place. The world continues consuming more silver than it is replacing. Over time, that has created a significant drawdown in available inventories. Since 2021, cumulative shortages are estimated to have removed between 760 million and 820 million ounces from global stockpiles. That is an extraordinary number when viewed in context. It represents an amount approaching an entire year of worldwide mine production. Those missing ounces did not reappear when silver fell. They did not come back because the dollar strengthened. They did not return because traders began expecting another Federal Reserve rate increase. The physical reality remains exactly the same. This is one of the reasons many long-term observers remain focused on the bigger picture rather than short-term price fluctuations. A market can experience temporary weakness, but supply shortages do not disappear overnight. Then there is the demand side of the equation. Silver occupies a unique position among precious metals because its value is tied not only to investment demand, but also to industrial consumption. Modern technology depends heavily on silver's conductive properties. In many applications, there are few practical alternatives capable of delivering the same performance at scale. Solar energy is one of the clearest examples. Current estimates suggest that solar panel manufacturing consumes approximately 200 million ounces of silver every year. That represents roughly 1/4 of global annual mine production. The scale is enormous. And unlike speculative demand, industrial demand often continues regardless of short-term market sentiment. Manufacturers do not suddenly stop producing solar panels because silver experiences a volatile week. Production decisions are driven by long-term infrastructure plans, energy investments, and technological requirements. The same principle extends to electric vehicles. Modern EVs require substantially more silver than traditional gasoline-powered vehicles. As adoption expands globally, silver remains an important component in the production process. Then there are semiconductors, advanced electronics, telecommunication systems, artificial intelligence infrastructure, and expanding data center networks. Each of these sectors relies on technologies that consume silver in meaningful quantities. The key point is not that demand can never fluctuate. It can. The key point is that the long-term drivers behind silver consumption remain active. Nothing that happened this week changed the existence of solar energy. Nothing that happened this week eliminated electric vehicles. Nothing that happened this week reduced the world's need for semiconductors or advanced computing systems. The industrial story remains intact. Now let's examine another factor that often receives less attention than it deserves. Silver supply is unusually difficult to increase. Many investors assume that higher prices naturally lead to more production. While that relationship exists in many commodity markets, silver is different because a large percentage of global output comes as a byproduct of mining operations focused on other metals. Approximately 70% of silver production originates from mines primarily targeting gold, copper, zinc, or other resources. That creates an important constraint. Even if silver prices rise sharply, producers cannot instantly flood the market with new supply. Their production decisions are often driven by the economics of entirely different metals. As a result, silver supply tends to respond slowly. That structural limitation remains unchanged regardless of whether prices rise or fall in the short term. This creates a fascinating contradiction. The market price has been cut by more than half from its peak, yet the major supply constraints remain. The industrial demand drivers remain. The long-term deficit remains. The physical characteristics of the market remain. The foundation appears largely untouched. And whenever a large gap develops between price behavior and fundamental conditions, investors begin searching for signs that the divergence may eventually close. That is where technical levels become useful. Not because charts predict the future with certainty, but because they help identify areas where market participants are making important decisions. At the moment, analysts are paying close attention to the region between approximately $55 and $59. This range has become one of the most important support zones in the silver market. Support levels matter because they reveal where buyers are willing to step in and absorb selling pressure. When silver declined, it did not stop randomly. It moved into an area that previously attracted buying interest. That immediately transformed the zone into a key battleground. On one side, our investors focused primarily on Federal Reserve policy, rising rate expectations, and dollar strength. On the other side, our investors focused on deficits, industrial demand, inventory drawdowns, and long-term scarcity. The market's behavior around this area could provide valuable clues regarding which side currently holds the stronger hand. If silver stabilizes and begins building support above roughly $55 to $56, it would suggest that long-term buyers are willing to absorb the selling pressure generated by fear and uncertainty. In that scenario, the market may be approaching a point of exhaustion where sellers become less influential. However, if support fails decisively, a different message emerges. A break below $55 could expose silver to another leg lower, potentially opening the door toward the low 50s. That possibility deserves serious consideration. One of the biggest mistakes investors make during volatile periods is assuming only one outcome is possible. The reality is that markets remain uncertain until they reveal their direction. What matters is recognizing the levels that provide meaningful information, and right now, few levels matter more than this one. But support alone will not determine the future path of silver. To understand what comes next, we must return to the factor that created the decline in the first place: the Federal Reserve. Everything currently revolves around inflation expectations. The bearish argument for silver is built upon a simple assumption. Inflation remains stubbornly high, forcing policymakers to maintain a restrictive stance. If that assumption proves correct, higher rates could continue supporting the dollar and pressuring precious metals. But there is another possibility. One of the developments attracting increasing attention is the potential impact of additional oil supply entering global markets through the Iran agreement. Energy prices play a major role in inflation calculations. When oil prices decline, transportation costs often fall. Production costs can ease. Broader inflation pressures can gradually soften throughout the economy. If that process accelerates, the Federal Reserve may find itself under less pressure to maintain an aggressive position. And if inflation data begins surprising to the downside, market expectations could shift very quickly. Remember how rapidly hike probabilities moved from around 57% to nearly 90%. Expectations can change in both directions. That is why upcoming inflation reports are becoming so important. Among them, the Personal Consumption Expenditures Index, or PCE, remains especially significant because it is the inflation measure most closely watched by the Federal Reserve. A softer-than-expected reading could challenge the narrative currently supporting dollar strength, and if that narrative begins to weaken, the entire landscape surrounding silver may begin changing with it, because the same macro force responsible for driving the decline could eventually become far less powerful than investors currently believe. That possibility is precisely why some of the most experienced participants in the market are viewing today's fear through a very different lens than the average investor. Part 3. The difference between professional investors and emotional investors is not that one group can predict the future. It is that they often focus on different questions. Emotional investors tend to ask what just happened. Professional investors tend to ask what the market may already have priced in. That distinction becomes especially important during periods of extreme volatility because the most dramatic headlines rarely tell the entire story. Right now, while fear dominates conversations about silver, large institutions continue publishing forecasts that imply substantially higher prices than today's market levels. Consider the range of expectations currently available. JP Morgan's research team has projected average silver prices around $81. Goldman Sachs has discussed scenarios ranging from approximately $85 to $100. Bank of America has outlined bullish outcomes that could reach $135 and potentially exceed $300 if physical shortages become significantly more severe. Whether those forecasts ultimately prove correct is impossible to know. Forecasts are not guarantees. However, they reveal something important. The institutions conducting extensive research into global commodities, monetary policy, industrial demand, and capital flows are not behaving as though silver's long-term story has collapsed. Instead, they appear to view the current weakness as a temporary event, occurring within a much larger framework. That perspective becomes even more interesting when we examine activity in the physical market. Throughout the year, sophisticated buyers have continued accumulating physical silver. Significant quantities of metal have been removed from exchange inventories as investors choose direct ownership rather than relying exclusively on paper exposure. That behavior sends a message. Participants taking delivery of physical metal are making decisions based on long-term expectations rather than short-term price swings. They are looking beyond weekly volatility. They are focusing on inventory levels, supply deficits, industrial demand, and future availability. And that creates an important contrast. While some investors see a collapsing chart and conclude that the opportunity has disappeared, others see the same chart and ask whether temporary macroeconomic pressures have created a discount. This type of disagreement is not unusual. In fact, it appears throughout financial history. Many of the most significant market bottoms felt terrible while they were forming. At the time, they rarely looked like opportunities. They looked like disasters. The reason is simple. Markets tend to reach emotional extremes. Optimism becomes excessive near major peaks. Fear becomes excessive near major lows. And because emotions are strongest at those moments, investors often struggle to evaluate conditions objectively. Silver's history provides several examples. In 1980, during the famous Hunt Brothers episode, silver surged toward $50 per ounce before suffering a devastating collapse. The decline exceeded 50% within a matter of weeks. Investors who experienced the crash firsthand believed the story was over. Confidence disappeared. Sentiment turned overwhelmingly negative. Yet silver did not vanish. The market eventually recovered and decades later reached entirely new highs. The crash felt permanent. It wasn't. A similar pattern emerged in 2011. Silver approached $50 once again before experiencing one of the sharpest declines in its modern history. Prices fell from roughly $48 to $33 in only a handful of trading sessions. The reaction was predictable. Fear spread rapidly. Commentators declared the bull market finished. Investors questioned whether the metal would ever recover. Yet the long-term story continued evolving. The important lesson from these examples is not that history repeats exactly. It doesn't. Every cycle contains unique characteristics. The lesson is that silver has repeatedly demonstrated an ability to experience violent corrections without invalidating its broader narrative. Volatility is part of the asset. That reality often surprises newer investors because few markets move as dramatically as silver. Large rallies, sharp declines, sudden reversals. These characteristics have defined silver for decades. However, today's environment includes several factors that make comparisons especially interesting. The market currently faces a multi-year structural deficit. Industrial demand from solar energy remains significant. Artificial intelligence infrastructure is creating additional demand for advanced electronics and computing systems. Electric vehicle adoption continues expanding. Meanwhile, supply growth remains constrained by the byproduct nature of silver mining. These are not identical conditions to previous cycles. In several respects, the underlying fundamentals appear stronger than those seen during earlier periods of volatility. That observation brings us back to the central question. What actually broke? Did industrial demand suddenly disappear? No. Did global stockpiles suddenly refill? No. Did supply constraints vanish? No. Did technological demand cease to exist? No. The primary change occurred in expectations surrounding Federal Reserve policy and the US dollar. That distinction matters because causes influence outcomes. If the cause is temporary, the consequences may also prove temporary. Of course, responsible analysis requires acknowledging the risks. There are genuine reasons for caution. The Federal Reserve remains the dominant force influencing market sentiment. If inflation remains elevated and upcoming economic data continues surprising to the upside, policymakers may maintain an aggressive stance longer than many investors expect. In that environment, higher rates could continue supporting the dollar, and if the dollar continues strengthening, silver could face additional pressure. A decisive break below the critical support region could expose the market to lower levels, potentially reaching the low 50s. In an extreme scenario, even prices in the upper 40s cannot be completely ruled out. Investors should understand that possibility. There is also the issue of demand efficiency. When silver prices surged earlier in the year, some manufacturers began reducing the amount of silver used in certain applications. This process, often referred to as thrifting, represents a legitimate challenge because higher prices can encourage industries to find ways to use less metal. While that does not eliminate demand, it can moderate growth rates over time. Timing represents another important risk. Many investors underestimate how long markets can remain disconnected from fundamentals. A thesis can be correct and still take months to unfold. Being right eventually is not always comfortable. Volatility can test conviction long before the market validates a position. These risks deserve consideration because successful investing requires balancing opportunity against uncertainty. When we combine all available evidence, a more nuanced picture emerges. In the short term, the bearish side currently possesses momentum. Federal Reserve expectations remain elevated, the dollar remains strong, sentiment remains cautious. Those forces are real and continue influencing prices. In the longer term, however, the bullish argument remains supported by structural deficits, persistent industrial demand, constrained supply growth, and ongoing institutional interest. Both realities exist simultaneously. The challenge for investors is determining which time horizon matters most to them. If your focus is measured in days or weeks, Federal Reserve policy may dominate the conversation. If your focus extends years into the future, supply and demand dynamics become increasingly important. That distinction often determines how investors interpret the exact same market conditions. Perhaps the most useful approach is to focus on evidence rather than emotion. Watch the support zone around $55 to $56. Monitor inflation data, particularly the PCE index. Pay attention to oil prices and developments that could influence future inflation expectations. Those factors will likely provide more insight into silver's direction than any headline predicting certainty, because certainty rarely exists in markets. Probability does. And probabilities change as new information emerges. Stepping back, the broader picture becomes clearer. Silver sits near $73 after a decline exceeding 50% from its highs. The move has been painful. The fear is understandable. But the decline appears to have been driven primarily by a powerful shift in monetary policy expectations rather than a collapse in silver's underlying fundamentals. The market moved from expecting a relatively soft Federal Reserve to pricing nearly a 90% probability of additional tightening. The dollar surged, precious metals weakened, yet the structural drivers behind silver remained largely intact. The supply deficit remained, industrial demand remained, physical accumulation continued, long-term constraints remained. That does not guarantee an immediate recovery. Markets rarely move that neatly. What it does suggest is that understanding the cause of the decline is essential for understanding what may happen next, because throughout history, major opportunities and major mistakes have often emerged from the same moments of uncertainty. The difference usually comes down to whether investors react to fear or analyze the forces creating it. And right now, the forces driving silver appear far more complex than a simple story of collapsing demand or broken fundamentals. The weeks ahead will provide additional clarity, inflation data will arrive, Federal Reserve expectations will evolve, the dollar will either continue strengthening or begin losing momentum, support levels will either hold or fail. Those developments will shape the next chapter, but regardless of the path silver ultimately takes, understanding the real reasons behind this sell-off places you in a stronger position than investors relying solely on panic, headlines, or emotion, because in markets, understanding the cause is often far more valuable than reacting to the effect.